Hello friends, welcome to our lecture series on analytics in finance. In this series today we are going to discuss about financial time series, and in that discussion on financial time series, this is going to be part 1 of financial time series discussion. And for your convenience, I have planned this lecture like this, that I'll first be telling you about the time series and their characteristics, so that you understand that how this time series is going to be used for the purpose of financial decision making process. And then we'll talk about asset returns, distributional properties of returns, and eventually we shall review the statistical distributions and properties of financial time series. So before we talk about the time series, let me first tell you why this time series is important and what we are doing in the topic of analytics in finance. And when we talk about financial analytics, as a subject, in that we have to discuss about the data. We have to take up the data, and data is basically our source of information, the only source on the basis of which the entire technique or the entire analytics is dependent upon. So whatever we do into analytics, we need some kind of data at one point or the other, and we have to make use of that data with the help of different techniques. So I thought it pertinent to first tell you what is time series, what we do into that, so that you can better understand, you can have a better understanding of financial time series. Because this time series is going to be applied in case of financial data, and there we shall be drawing inferences, taking decisions. At times we have to simply observe, at times we have to draw some inferences out of data. We want data to speak, as I have been telling you from the very beginning, that we want data to speak about the reality, about the process. So keeping all that in mind, I have planned this lecture like that I'll first be telling you about time series. So what is time series? As these two words, they themselves are indicating that a series of data is available and it is in relation to time. So when data is planned according to time or in relation to time, we call it time series. So data generated by process over a time period, or what you call as a cross time period, that is called time series. So I'm having a data which is generated by processes over a time period, that is called time series, and this time series data is basically used to describe and predict output of processes. So whatever processes we are describing and predicting that output of a specific process which we are following. That out of this process, can I tell? Suppose I'm having a data of last 10 years. Can I have a prediction of the data or the value for the 11th year or so on? So we have to understand that the data for 10 years are provided to us, and for 11th year or 12th year we have to make a prediction. So we are not only supposed to predict, but we are also supposed to describe into that process that what is my prediction and on what ground I am making this kind of prediction. That is what we do in case of time series analysis. And broadly speaking, there are two different types of analysis. One is descriptive analysis, in which we are trying to understand the pattern. What is the pattern? We are trying to describe what has happened in the past, and on the basis of that, we are trying to find the pattern. It is just like in your examination attempts, when you are preparing for a specific examination, you always look for the previous year question papers, at least for 3 years or 5 years. Why do we do so? Why do we try to have a look into the previous year question paper? Because our motive is to understand what kind of question paper we are going to receive, and the level of question which the examiner is putting forward in front of us. That is something which is our point of concern in case of descriptive analysis. So here also, just like in examination question, we try to know that what kind of questions are being asked, what is the pattern, what is the marking scheme. Likewise, here also we are trying to understand the pattern. So in that example of examination question paper, we were trying to find the pattern, that in which pattern the question is being asked, which unit of the syllabi of the subject is having greater prominence in relation to the other units or other segments. Likewise, in case of time series data also, we try to understand the pattern so that we can better predict. We can have a better level of prediction, and that is what is our motive. And second objective of time series analysis is inferential analysis, where we try to draw inferences out of the data, and that is the second part of our analysis, that is forecasting future values, that this is going to be my future value. But do remember, my dear learners, in order to forecast the future values, we need to understand the pattern first. So if you ask me that, sir, descriptive analysis and inferential analysis, these two are different, these two have different motives, I would say no. These are basically interlinked. So the inferences which I'm going to draw out of the data available, it cannot be done unless I try to understand the pattern. I have a better understanding of pattern. I cannot draw inferences. It is just like saying that without knowing the entire domain, I'm going to give a prediction. So prediction or forecasting is something which comes at the end, at the very later stage, at the very advanced stage, where we simply give the output, or you can say it is an outcome of this entire time series analysis. So what is time series? I have told you that it is basically a data generated by processes across a time period, for a given time period, and it is helping us in describing and predicting the output of processes. And for that we have two different types of analysis: descriptive analysis and inferential analysis. Now coming to the descriptive analysis, what we do into descriptive analysis, as I told you that we are trying to draw some pattern, we are trying to understand the pattern which we are witnessing on the basis of data available, and the best example for that is index number. Now what is index number? Before I tell you what we do and how do we calculate the index number, let me first tell you what is the purpose of calculating index number, what is the use of it. When you were studying statistics, you must have witnessed the topic of index number, and there the teacher must have told you that you have to take a base year and you have to take a year for which you are doing the calculation, the current year, and then you calculate the index number. And the examiner or the teacher used to tell you that in case of index number, your answer should always be more than 100, because if you are taking 100 as a base. So suppose if your index number comes to be 130, it means there is a 30% change into your index number. And there are different techniques for computing index number, and one of the very popular technique is Fisher's ideal index number, where we used to study that it is ideal index number. And the students used to ask me that, sir, why do we call it ideal index number? Why it is ideal? What makes it ideal? So it is basically the very nature of this index number, Fisher's ideal index number, which is making it ideal. Because there are two components to it. One is the factor, and another is time. And this very technique fulfills or qualifies both the test. One is time reversal test, another is factor reversal test. So since Fisher's ideal index number is fulfilling or completing or conforming to both the test, that is time reversal and factor reversal test, that is why we call it ideal index number, Fisher's ideal index number. So I just thought, since we are talking about index number, I just thought to give you a recap of what you have studied in the subject of statistics, and that knowledge is going to be used in case of financial analytics as well. So in descriptive analysis, we have index number, and for descriptive analysis we are going to have exponential smoothing, when we are going to exercise this exponential smoothing in order to have the proper analysis, in order to have the real picture of the data, and we are trying to eliminate the outliers. I'll be telling you the way we remove the outliers. Some people are against data cleaning. They say that what is the use? When you clean the data, it means you are getting biased. It is not so every time. It is not right, it is not correct every time that when we go for data cleaning. See, in the process of data cleaning, we are trying to eliminate those factors which may have negative or adverse impact on our decision making, on our inferences, or you can say on our prediction. Because at times we are trying to make a prediction on the basis of previous data, and out of that series of data there are 1 or 2 points where we know that there are certain subjective matters, certain qualitative matters which have affected the very value of data, and that is something which we need to understand. Because at times data may give you some confusing results. you find some average information. I would tell you a very interesting example about it, that at times you find that, suppose if you take three members in a family, and one is earning 1 lakh rupees per month, another is earning 5,000, and second one is earning 5,000 rupees. So you are having this kind of dispersion in terms of data. So one person is earning 1 lakh rupees and other two members are earning 5,000 and 5,000. So total earning is 1,10,000. And for this 1,10,000, or you can say, in order to make our calculation more easy, we can have 1,10,000 and 10,000, 1,20,000. And when you divide it by 3, what you get? 40,000. So the average income which you are getting for the family is 40,000 rupees, but interestingly, none of them are having average monthly income of 40,000 rupees. One person is earning 1 lakh rupees, another two are earning 10,000 rupees each. So 1,20,000 divided by 3 is giving me the average income of 40,000. So we need to understand that simple average is not going to work for us, and for that only we were using dispersion and all as a technique. So in case of exponential smoothing, what we do, I'll be telling you, and why we do that also I shall explain to you. So time series component, we have to understand what is there into time series component, and for that we are starting with the very discussion of index number, which is very much part and parcel of descriptive analysis. So index number, what it does, it measures change over time related to a base period. So for index number, one thing is clear, that we are going to have a measurement of change over a time period. Suppose if I take example of year 2023 and I'm willing to make, I'm having data for 2024, and I just want to know what is the percentage change into that, what is the change, what is the rate of change into that period. So the base period is basically acting as a base, and in relation to that base period we are trying to have a measurement of change over this period of time. It can be 10 years, it can be 1 year, it can be 5 years. According to our requirement, we do this kind of calculation. Now this index number is again of two types. One is price index, which, as the term itself is indicating, that it is giving us a measurement of changes in price. For instance, we have consumer price index, we have wholesale price index, we have consumer price index and in the market, and we think that from where this index is coming. So when consumer price index we are looking at, it means that index, it is something which must have been calculated by someone. We consider this to be a given value, but no, it is calculated by people like me and you, and we are computing a price index. And price index is nothing but it is but it's a rate of change in the price of consumer goods in relation to a time period. So suppose if I take example of last year consumer prices and current year consumer prices, I can tell you about the inflation, that see, this is a rate of change, this is the consumer price index. And on the basis of that only, if you talk about the government employees, about their dearness allowances or dearness relief, DR what we call, for the pensioners, so that is something which is based on this change in price, this price index only. So consumer price index is nothing but your index number. So unknowingly what we are doing, we were making use of this price index without having any idea that in what manner it is being calculated, because unless we go for studying financial analytics or statistics as a subject, we think that these values are given, but do remember, my dear learners, these are calculated values, and I'll tell you how do we calculate. Then the second type of index number is quantity index. It is giving a measurement of changes in quantity, as the term itself is showing, indicating, reflecting quantity index. So number of cars manufactured annually. Suppose I take example of a company which is a manufacturer of cars, and I take the data of previous year production manufacturing and current year manufacturing, and I calculate quantity index. That suppose if previous year is a base year, what is the value in the current year? Suppose previous year value is taken to be 100 and current year value comes to be 110. So it means there is a 10% increase in the quantity index. So it is giving me the measurement of changes in quantity. So it can be price index, it can be quantity index. Now I'll be telling you how to calculate a simple index number. Suppose there is a small example and examiner is willing you to calculate the index number for each period with some formula, and the values are given. They are asking you to obtain the price or quantities for the commodity over the time period, and you have to calculate the index number for each period. And you have to select, for that you have to first select a base period. Two periods are given, base period you select, and then you calculate the index with the help of a formula. And suppose if I take index number at time t, suppose if I indicate time by alphabet t, small t, this can be the formula for the index number. Time series value at time t, suppose if I am taking example of current year 2023, so the time series value in that time series data set, whatever value is given in the year t, that is current year, that will become our numerator, and it shall be divided by the denominator, that is time series value at the base period. Now deciding this base period is equally important. What base period you have taken, that is going to give you a reflection of the change in data. So time series value at the base period, and you multiply it by 100, cause and this is the reason why my answer is always coming in terms of percentage, or what you call as more than 100. So time series value at time t, it becomes the numerator, and base year value becomes your denominator. So in short, I would say the current year value divided by base year value in the time series data into 100. So suppose if I am having a time series data of 10 years, and for every year I wish to calculate, given the base year of year 2000, suppose I am having a data set of 2000, year 2000 to 2023, 23 years data, and I take year 2000 as base. So from year 2000 to 2023, for every year I can calculate the index number, that across the period what is the change. What is the change in every year? That is something which I can calculate. So in terms of formula, if you ask me, I would say it is yt divided by y0 into 100, where it is basically the index number at time t, yt is the time series value at your time t, that is current period, and y0 is the time series value at the base period. So you can say current divided by base into 100 is the simplest formula of computing simple index number. Now suppose if I give you a numerical problem wherein the data from year 1990 till 2006 is given to us in terms of rupee, and this table is indicating about the price per unit of a product for the year 1990 to 2006 for this time period. Now my dear learners, why do we call it time series? Here I would like to clarify, I would like to re-explain it to you, that whenever a data belongs to a time period, when you have a series of data which belongs to the specific time, when your year-wise data is available, we call it time series. Year means time, and since you have a series of data, you call it time series. So the data provided from the year 1990 till 2006 is nothing but your time series data. And we have decided to use 1990 as a base year, and examiner is asking us to calculate the simple index number for 3 years, that is 1990, 1998 and 2006. Now my dear learners, whenever you have to calculate the index number for the base year, and the year which you have chosen as base year, and your examiner gives you a kind of reminder, or your teacher is giving you a kind of hint that do remember that the answer of your index number should always be more than 100. I always try to avoid this, giving this kind of statement to my learners, that it will always be more than 100. It cannot be. It depends. If your base year and the current year value, they are the same, how can it be more than 100? So what we say is normal, in normal course of action it is more than 100, but there can be a situation where it can be 100 also. So that is something which we as a faculty member, as a teacher, we are supposed to tell our learners, that we should not have that extremist kind of statement. We should try to avoid avoiding giving these kind of statements. So let us calculate the index number for the year 1990. And I deliberately took up this information into this question. Reason being, because students are very much clear, very much inculcated about this statement that it should always be more than 100. So here it is 100. 1990 price divided by 1990 price. Of course, the price is supposed to be the same, your base year and your current year. So you have taken year 1990 as a base year, and your current year value is also 1.299 and base year value is also 1.299. So your value comes to be 100 because you are multiplying it by 100. So you are having the index number for the year 1990 to be 100. Now moving on to the second set of data, when we are calculating the index number for the year 1998. Now here you have to understand, my dear learners, we have taken 1998 price as numerator and the base year is your denominator, that is the price of 1990. 1.03 is divided by 1.299 and we are finding the value of 79.3. So what we are getting, it is indicating that price had dropped by 20.7%. So 100 from 100 to 79.3, when I am giving a calculation of index number between 1990 and 1998, it is coming to be 79.3. So it is basically giving me an idea that there is a decline in relation to base period. So here the base period is basically having a value of 1.299 and in the year 1998 the value comes to be 1.03, which is less than the base year price, so there is a decline. So we have got this value of 79.3. It is just like simply computing a percentage. We have simply computed the percentage of 79.3, so it is a percentage change and we are calling it index number. So for the next year, when I am computing the index number for the year 2006, so the price of 2006 becomes your current year price and base year is again 1990, 1.299 and your value comes to be 198. So it is indicating that price had risen by 98% between the year 1990 to 2006. So my dear learners, you should avoid having this kind of inferences out of data that my answer, this will become the direction of my answer. You have to simply learn that in index number what we are doing, there is a current year and there is a base year. So we are trying to find the rate of difference, rate of change vis-a-vis your base year, whatever base year you have chosen. So since here the data was ranging from the year 1990 to 2006, so deliberately we took the 1990 year as the base year and we have computed the value, that is 198. So this was the simplest calculation, my dear learners, wherein we computed the index number, and you can also have a graphical presentation to this data. When you plot it on a graph, you find the trend line like this. So if you see the connecting lines from 1990, initially it was almost forming a straight line, later on having certain upward trend in the year 2000, and then in 2001 it was stagnant, and then later on we are finding 2004 onwards, what we are finding that it is going to show a kind of upward trend. So with the help of this kind of graphical presentation, also by plotting this trend line, we can make a prediction of the future value, that what will be the fate of this value in the year 2007. Deliberately I have not told you about what is the nature of this data. I have simply told you that year and data is given, so time and series of data is given, that's why we call it time series, because my motto was to tell you that it is how do we go for dealing with the time series data. So here, with the help of this graphical presentation, we are trying to witness the pattern with the help of this trend line. So this pattern is very much visible, that initially it is parallel to x-axis, later on slight change, and now eventually it is showing an upward trend into this value. The second aspect of index number is composite index number. I'll briefly tell you about composite index number. It is made up of two or more commodities. When you club two or more commodities, we call it composite index number. And a simple index using total price or total quantity of all the series. It is basically just like that. And the disadvantage of it is that quantity of each commodity purchased is not considered, because you are having a composite calculation, you are computing composite index number, so quantity of each commodity purchased you are not considering. And for instance, if I give you an example of the closing stock prices of a company, which gives you data of 2-3 companies, and there we can have a composite calculation. I shall be dealing with some numerical problems in due course of our discussion, where I'll show you numerically the way we compute composite index number. So my dear learners, with the help of time series data, what we are doing here, we are trying to find the rate of change in data. We are trying to witness the pattern so that we are in a position to make a prediction. And once this data belongs to the financial matter, suppose if the data belongs to money market or capital market or any business situation or any segment of a product, what it becomes, when it belongs to financial component, or when it belongs to finance as a subject, either it is money market or it is capital market, this time series is automatically going to have a prefix of financial time series. So financial time series is not very new to you. It is just like the other kind of time series data. The only point is that here we need some financial information, we need to have some financial knowledge to draw inferences out of the data. So in this way, my dear learners, I have tried to explain you what we do into this topic of time series analysis with the help of descriptive analysis technique, index number. And in the next lecture of mine, I'll be telling you about the composite index number. How do we do the calculation? I hope you must have understood and enjoyed today's lecture of mine. Thank you so much.